Well, let's straight away get to the pharma major. Cipla Q1 numbers were a bit subdued at the revenue front. The key highlight for the quarter was the margin improvement on a quarter-on-quarter basis. CNBC TV18's Archana Shukla caught up with the management and began by asking them about the margin pressures in this quarter and whether they continue seeing it going forward.
I think our biggest pressures have been commodity price increases that are happening around the world. We've seen them in China, coming out of China. We've seen fuel prices going up as a result of that, and industry responds to fuel price increases as well. So we've seen this. There is limited pricing power across the world now for pharmaceuticals. You know, we've seen actions in India around pricing. We've seen actions in the rest of the world. We are also not immune to US pressures, though we have a much lower base. We don't get hit as much, but we have those pressures as well. So we're seeing price deflation across our markets. We're seeing commodity price increases. And considering that, I think we managed to a very good outcome. We are actually pleased. We are ahead of our internal estimates on where we've reached. But Kedar, do you want to add some specifics?
No, I think that's fair. I think this was in line, in fact, a little bit better than what we thought we would end up with.
Yeah, because it's not so much in line with what the market was estimating. Market was estimating you to do slightly better than this.
Yeah, but sequentially we increased margins by more than 300 basis points. Currency came to the rescue. Mix of businesses has been good. So API did well this time. RX business in India grew by more than 22%. So all of that came handy. Costs have been in control. And going forward, what's going to happen, a little bit forward outlook, as the mix of limited competition contribution improves in our US business, that will come handy as well.
But because these pricing pressures are going to continue to stay for some more time, so how are you looking at margin, let's say, in the next few quarters and for this fiscal?
What I would think, so a couple of factors will play. In the first quarter, the impact of currency on the import cost did not play out as well because we consumed stocks out of the opening inventories. So that will be adverse going forward. In the revenues, currency will come to the rescue. That is one. But as the contribution from the limited competition launches in US improves, that will, improve the margins. So
it will stay at around 18-19%, or you're hoping to cross 20% in this fiscal?
Well, typically quarter 2, quarter 3 for us are better quarters. Quarter 4 is usually a worse quarter because of the season effect and, of the businesses worldwide. So we're hoping to be higher than where we were in quarter 1. Now, exactly, we don't guide to numbers, but we had given a guidance at the beginning of the year that we will improve our margins. So I think we're on that track. We're hopeful. We're hopeful of where we end up.
US has certainly been the pain point, flat growth, lots of pricing pressure as well. How does the trajectory look like, and what, apart from pricing, are there other efforts that you're using in the US market?
See, US as a market, there are two things that we look at. The first is we had our own issues, right? We had our own issues of supply which have lasted us beyond a quarter, but now they're behind us, thankfully. So I think that's one result why our quarter-to-quarter movement has not moved up. The second issue, which is also important, is that the US deflates at about 10%. So we have shown a flat growth, considering the deflation in the market, considering our own issues in terms of capacity and supply. But I think, I think the subsequent quarter should be bigger for us in the US.
Okay. And what is going to kind of drive that, growth in the US market for you?
See, what we track is the ratio of launches which we have made in the last 12 months. How much of those have contributed in the current quarter? That ratio is improving for us. So in this quarter, whatever products we have launched in the last 12 months, they contributed 30%. And that's growing. And all of those are high margin.
And you've also rationalized a couple of your product portfolios in the US market, which has some sort of an impact on the numbers. Could you?
Yeah, so when we rationalized it, what's happened is that it's not in the numbers anymore, right? And we've rationalized it because there's no point producing it, because we can show the sales, but it doesn't bring us enough profit. So I think all of this has come together for us, and we are happy that many people are showing US decline in numbers, right? We are happy that we're at least flat. Right, and now we're hoping that we get to growth. So hopefully, this quarter, the next quarter, we should begin to see growth.
Coming to India, Kedar, good performance of this quarter. What really is driving the growth here in India is, the focus on in-licensed products, kind of adding more value?
There are multiple things which we are trying in India. India is a growth driver for us. It's our home market. be therapy shaping initiatives to improve awareness on respiratory, be it this in-license launches that you referred to. There are several things that we are trying, and all of that is contributing to sales. In terms of in June or early July, I think the season is not yet picked up, so we could have done actually more than what we did. But yes, the generics business delivered very strongly. Prescription business could have done well. In totality about 22%, and you have to remember last year numbers includes excise. This year GST is completely excluded. So actual in-market growth is higher than what we have reported.
Okay, just before I let you go, where do you see FY19 to be ending for Cipla in terms of revenues and margins?
So we've spoken thematically. So we have not given guidance in terms of numbers, but margin improvement remains our priority. We've spoken about $1 billion revenues for Indian market. We said